Welcome back. Charts are used by traders to conduct technical analysis. As we know, the main reason is to come up with a view on potential future price movements. If you develop into a technical trader, charting will be one of your most important tools. And by the end of our courses, reading and analyzing charts will become second nature.
Sounds good. Are there different types of chart? I've seen a few different ones.
There are many different types of charts, but in this lesson we will be looking at the most popular three: line, bar and candlestick charts. Let's start by explaining what a chart actually is. To explain it in simple terms, a chart is a sequence of prices for a particular financial security plotted over a selected duration of time for a predefined time frame.
Okay, so how exactly do we read charts?
Well, let's look at this chart here. The vertical axis represents the price scale. The horizontal axis represents the time scale. Prices are always plotted from left to right in chronological order. The most recent price action is displayed on the right-hand side of the chart.
Okay, I'm with you so far. You said the data is plotted for predefined time frame. What do you mean by that?
If you look here, you'll see the time frame. This particular chart is a daily chart, which means each data point represents a full trading day. If I change it to monthly, each data point represents a full trading month. If I show you a minute chart, then each period is a minute. Remember, for all the charts that I'm showing you, it's still the same financial instrument.
Yes, that makes sense. And how much data do we need exactly? What's the best time frame to use?
Well, it really depends on what type of trader you are. Your trading style and investment time frame normally dictate the chart time frame you'll be using. Long-term historical charts, like those that are monthly and weekly, are typically used by investors. Passive traders normally use daily charts. Short-term traders tend to use the intraday time frames.
I can see the time frame called tick on the options there. What's that mean?
A tick is every time that market changes its price, so a tick chart has a tick for each data point. Markets can update multiple times a second, so this chart can move very quickly. It's normally used by very short-term traders.
Okay, so choosing a chart time frame is all down to the type of trading that suits my style and the length of time I intend to trade for.
Well, pretty much. Later in the course, we will also look at how to use a combination of long and short-term charts for the same instrument. In the trading style that we are teaching you in our more advanced courses, long-term timeframes indicate a prevailing trend and short-term timeframes are used for the execution of the trade. So let's begin by looking at linear charts. Linear charts are the simplest type to read. They display a line from one closing price to the next.
What's a closing price? I don't think we've come across that term before.
A closing price is the last price for that period. So if it's a daily chart like this one, the closing price is the price the market closes on for the day. If it's an hourly chart, then it's the last price of each hour. Be aware, closing times vary by market and your broker will publish that information in their platform.
Got it. So why would we use linear charts over another type?
Well, linear charts are simple, quick and easy to use. They are pretty common and we've been using them to date in our courses. I reckon the most people would be able to explain what one is fairly easily.
Yeah, I don't have much experience with charts, but I know what a linear chart is.
Okay, Long-term investors use linear charts when they want to ignore any intra-period price moves, which in their time frame they would consider to be noise. The closing price, especially in daily time frames, is considered by longer-term investors to be the most important. It is the price traders can sleep on, so to speak.
Yes, this makes sense. So smaller intraday fluctuations in price aren't as important to long-term investors. It's the closing price that they're interested in when conducting their analysis.
Exactly. So, although linear charts may have many benefits, there are a few drawbacks that you need to know about too.
Okay, what are they?
Well, the benefits of linear charts can also be the drawbacks.
How so?
Well, linear charts only show the closing price, which for some traders isn't enough information. Some want to see the intra-period moves because this can provide them with a lot of useful information about the market.
So what if we wanted to see the intra-period moves?
So, next up, we are going to look at bar charts. These are also called OHLC charts because they show the opening, the high, the low, and the closing prices for the period. This is what a single bar for a period might look like. The little horizontal line on the left here is the opening price. This is the first price for that period. The top of the vertical line defines the highest price for the period. The bottom of the vertical line is the lowest price for the time period, and the little horizontal line on the right is the closing price. This is the last price for that period.
This is all clear. I have one question though. Why would a trader use a bar chart over a linear chart, for instance?
Well, to put it simply, bar charts provide a greater deal more information. Let's pull up our last linear chart and show you what happens if we change it to a bar chart. We are not changing the market, just the chart type. You can almost instantly see the amount of additional information it gives you. Where we had one data point per period, now we have 4.
Yes, it's much clearer what has happened to the price during a particular period.
And with this type of chart, the bars are skinny and therefore very effective at displaying large amounts of data. It's also easier to read the data on a bar chart as the information isn't cluttered. Of course, there are drawbacks to bar charts too.
How so?
Well, for example, the opening and closing prices are given equal visual weight to the high and low prices. So when you have to interpret these charts quickly, I find this makes bar charts less intuitive. Let's move on to our third type of chart.
Okay, so I don't think I've ever heard of candlestick charts before.
You might have seen them before. Candlestick charting originated in Japan, where it was initially used as an analysis tool for rice trading. Today's version is a result of continuous improvement over a long period of time to harness it for use on the financial markets. This chart type is the most commonly used in trading. Candlestick charts show the same information as a bar chart. The open, high, low, and the close are all shown.
Okay, so how do we read a candlestick chart then?
Let's look at an example. So the vertical lines here and here display the high and the low prices. These are also known as shadows or sometimes wicks. The blocks in the middle display the open and the close. This is known as the body. They can be colored to indicate bullish and bearish ranges.
Bullish is when the market is moving up and bearish is when it's moving down, right?
Yes, they are normally green when the closing price is above the opening price. This is a bullish candle. A bearish candle is typically red when the opening price is above the closing price. Now, look what happens when we move from our bar chart to the candlestick chart. Immediately, you get a much better visual sense of what happened to the price.
What are the benefits of using candlestick charts then?
Candlestick charts are easy to use and interpret, so they are very good if you are a beginner.
They aren't that easy, Philip. But with a bit of practice, I can see myself getting used to them.
They place more emphasis on the open and closing price, which as a trader is important to monitor, but at the same time they don't ignore highs and lows.
Anything else?
Well, because they're colored and introduce a body, you can use candlestick charts to identify visual patterns which can tell us a lot more about what's happening in the market.
Really? That sounds interesting. What patterns?
We're going to spend a whole lesson introducing candlestick patterns next. You should also bear in mind that you can find similar information from OHLC bar charts, but in my opinion, it's harder to spot.
I have a feeling there's a but coming up.
Well, yes, each type of chart has its benefit and drawbacks. With candlesticks, it's difficult to get loads of data onto a single chart. Much harder than a bar chart. Plus, adding colors can bring emotion, which as traders we are trying to keep out of our analysis.
Are those the only drawbacks?
The main ones, yes.
Okay, then I think I like candlesticks.
Yes, me too. They are the type most traders use, and it's a good place to start. Before we finish with things, I want to stress, irrespective of the type, it is important to really understand what the chart type is telling you. Be consistent and don't jump between the chart types.
We looked at 3 popular types of chart that traders use. Which type you use depends on your personal preferences, trading style and time frame.
All charts use the same data, but not all charts display everything you might want to know. Each charting method provides its own unique interpretation, with its own benefits and drawbacks.
Looked at 3 types: line, bar and candlestick charts. Line charts only display the closing price, which might be appropriate for long-term investors. Bar charts use the closing price, but also display information on the opening, high and low prices for a particular period.
Candlestick charts display the same data points as bar charts, but add a body, shadow and colours, which help us identify bullish and bearish periods visually.
Thanks for the summary, guys. That wraps up our lesson on charts. See you in the next lesson, where we will introduce some distinctive candlestick patterns and what they suggest about the market.